With the uncertainty of the stock market getting larger, some are speculating a big melt up, while others expect a huge meltdown. Many of us are just wondering who is right, who should we listen to? Well, if you ask me, I would tell you both scenarios are possible, and with the degree of uncertainty in the market as we see now, there is an equal chance of either of it playing out. I know it sounds lame, but let me tell you this. The best money managers and the most intelligent investors didn't outperform the market by predicting the stock market. Instead, they did so by correctly managing their portfolio. And what does this mean to correctly manage one's portfolio? Today, I'm going to show you some basic portfolio management strategies that a lot of successful money managers use. So stay with me if you're interested. Welcome to the Wild Finance. On this channel, I share with you my investing tips and strategies to become financially free. Make sure to subscribe if you want to learn investing to reach your financial goals. Now, the first step of portfolio management is asset allocation, meaning how much money you are putting on each asset. I have already made a video on asset allocation, so you can watch that one first if you haven't already. Now, after you have your money allocated into different assets, most people are not actively managing their portfolio, meaning taking profit or cutting loss along the way, then readjusting and reallocating money into different assets. Most of us are riding the ups and downs of the stock market. There is no right or wrong of doing this. You will still make money in the end. And from a time-efficient point, that saves you a lot of time on investing. But if you have the interest and time, then managing your portfolio actively can be rewarding. Here, I'm not talking about day trading or frequently buy and sell based on technical analysis. I'm talking about setting up a strategy that you can follow to guide you through any market conditions with minimum emotion interference. Because our emotions are the biggest enemy to our logical decision-making process. Here is a simple strategy that you can use. Maintain a list of your highest conviction stocks. When you buy a stock, set up a price target for profit-taking as the price goes up. For example, always sell 20% of your shares position at a 30% price increase, and reallocate the money into the S&P 500 index fund. You can also progressively increase the sell percentage as the market progresses higher. For example, sell 50% of your remaining position when the price doubles. By doing so, you are actively taking profit from a higher risk asset and putting the money into a lower risk asset. The benefit of doing this is as the bull market progresses, you are preparing for the growing probability of a market correction anytime, while at the same time not missing out on the broader market uptrend. Because honestly, no one knows the exact date of a market correction or crash. All we can do is to prepare for the raining days when it is still sunny. And the longer it has been sunny days, the bigger chance that a rainy day is coming. And the market works the same. Now, the next is what you should do when a market correction happens. During a market correction, the lower risk assets like S&P 500 index fund will most probably decrease less and slower than a high risk assets like an individual growth stock. So what you need to do is to sell the index fund and buy back your highest conviction stocks at a discount. That is to buy the dip. And you can use a similar strategy, like for example, sell 30% of the index fund and put money into a stock when the stock price drops 20% every time. You can also progressively increase the percentage sell amount of the index fund with the market progresses downwards. For example, sell 50% of your index fund position on the first 20% drop and sell 80% of the remaining index fund position on the further 15% drop, and sell 100% of the remaining index fund on the further 10% drop. I know it sounds a bit complicated at the moment. So let me give you a real example here. Say if you have 100 shares of Tesla bought at $200 each. You sell 20%, that's 20 shares, when price increases 30% to $260. And when the price increases further 30% to $338, you sell 16 more shares, which is 20% of your remaining 80 shares. Now you have 64 shares remaining and $10,608 profit taken and put in the index fund. What happened next is Tesla stock corrected and dropped more than 20% to $274. But let's say you bought the dip at exact 20% drop, which is $219, and you used 55% of $10,608, which is around $5,800 to buy 20 shares of Tesla. Now you have 84 shares and $4,808 in the index fund. After the correction, the price increases 30% from $290 to $377. You sold 20% of 84 shares, which is 17 shares, and the price then increased another 30% to $490. You sold additional 13 shares. Now you have 54 shares left and extra $12,779 profit from the Tesla stock. The total profit is $12,779 plus the $4,808 from the previous sale. Now you have total $17,587. Well, luckily, Tesla corrected again from $501 to $333. Let's say you bought back using 50% of the index fund when it dropped first 20% to $400. So you used $8,000 and bought 20 shares. And you bought again when Tesla dropped another 15% to $340. So you used up 85% of the remaining index fund, that is $8,160 to buy 24 shares of Tesla. Now you have 98 shares and $1,427 in the index fund. With the market progress and you do the same again and again, now you have 103 shares and an additional $1,212 as profit. If we compare this to you only hold and didn't take profit, your original 100 shares is still 100 shares. But with this strategy, you increased your holdings by 3 shares, which is worth 3 times $570 equals $1,710, plus the extra $1,212 profit in the index fund. That's a total of $2,922 more than your original position. Although this is an oversimplified example on one stock, you can still see the benefit of using a portfolio management strategy, and if you use it to all your stock holdings, you are likely to outperform the market by 5 to 10% each year on average, which is incredible. And if we look at the Tesla chart today, it has been in this triangle consolidation since January this year, and it is now approaching the apex of this triangle, meaning the likelihood of a breakout is imminent. While we don't know the exact direction of this breakout, but from a historic point of view, the likelihood of breaking up is larger than breaking down. If you are long-term interested in Tesla stocks, I would urge you to wait for the breakout to happen and confirm before you jump into it if you haven't already loaded up on the previous 2 dips. What does a confirmed breakout mean? It means that the price does not break back into the triangle after it breaks up. If it falls back again, then it is a false breakout. And if it breaks down, the price is likely to retest the $500 level, and it could be a good entry price. But not financial advice as always. Now, let me know if you guys are interested in such an analysis of individual stocks in the future. Leave a comment down below with your stock of interest, and I will analyze it on my channel. I also want to give you a quick update on the 20-year Treasury bond. The 20-year bond price went up as high as $152 since our last video, and it has been consistently creating higher highs and higher lows. So it seems like it does want to go higher in the immediate future. This could hurt the broader stock market, and we saw a sell-off early on the 19th of July when the bond price rallied 2.5% in a day. But for the longer term, I'm eyeing this resistance trend line. A possible scenario could be the bond price rallies to $156 to hit the resistance line and falls back below $146. This could be bullish for the broader stock market. Another scenario could be the bond price rallies to $156 and retreats back to $149 and forms a higher low. This could indicate that the bond will attempt to retest the resistance at $156 later and maybe even break through the resistance line. And this could be bearish for the broader stock market. So if the second scenario plays out, we should probably take more profits soon as the likelihood of a broader market correction is on the horizon. And again, not financial advice. Please educate yourself properly before taking any actions. Now, don't forget to smash that like button because I am trying so hard to make these videos for you guys and I deserve that like. So smash it and I will see you in my next video. Bye!